If you take a snapshot of the start of the month and a snapshot at the end of the month, it doesn't look like there was too much that happened. I think we recorded the last session a little after the start of the month when the tariff announcements had been raised, and the result or outcome after that was pretty challenging for those that are in long-term assets. I think some markets were off in the order of 10 or 15%, which is confronting. If you fast forward to the end of the month though, those that stood the test of the month and were able to wear the challenge of the volatility, Australian markets were actually up for the month, surprisingly, so up around sort of 3.5–4%. US markets from a US investor's perspective were still a little negative, but surprisingly a lot stronger than what you probably would have thought given the volatility that was seen within the month. April was a great lesson in investing. It was one where if you allow your behaviours to determine your decision making, you would have been all over the place in terms of where you had your money deployed, how long you were actually invested for, what decisions you were making, and you wouldn't have been able to sleep at night. It would have been a real challenge. Investing is for the long term. You buy exposure to fixed interest markets, you buy exposure to companies, you buy exposure to indexes, all the fundamental or all the opportunities that you may have at your fingertips. You generally do so for no less than probably 5 to 10 years. And so, yes, there's a lot of uncertainty that can happen in the near term, as we saw through April, and if you reacted to those, it would have been a really challenging period for you. But fundamentals do play out over time. So policy uncertainties do come through from time to time, but generally if the demographics are in your favour and debts aren't too, there's not too much debt that's floating around, and companies will continue to find ways to make money. We take a long-term view, we take a diversified view, and hold a range of different assets for different time frames that we think blend into a portfolio to hopefully give people that sleep at night factor, that they can be trusting and confident in terms of what they're holding in their portfolios. And from a business perspective, probably what's being reported is backward looking. So that's actually happened probably in most cases before the tariffs were announced. But looking at the likes of Alphabet and Meta, Microsoft, big companies have had a number of very strong performance years from a share price performance, but they've performed well because their underlying fundamentals, so the profits, the structure of the businesses, the markets that they're in, the products that they've got are in demand and still growing in demand, and also probably a bit of pricing power with some of those larger organisations as well. So, we're seeing double-digit growth for those companies, which is still a pretty strong position to be in. Now, coming back to my comments, tariffs and the uncertainty of the environment that we're in will likely see some of that challenged in future. So, yes, some of those companies do have global earnings. It's not just US domestic earnings and earnings that may be impacted by increases of prices or increases of throughput costs for products that they're having to put into their supply chain or into their product line. So that's something that there are a number of companies that are starting to be cautious in the statements that they're making to the market in terms of what guidance they're providing. So that's probably the uncertainty of the future. Reflecting on what happened through April, clearly the tariff and policy announcements from Trump were a bit of a shock for equity markets. We got to a point partway through the month where that started to play through into fixed interest and bond markets and longer term bond markets as well. We saw quite a lot of volatility in bond yields, and I think that was part of what led to a bit of a pause in the policy announcements with the tariffs, to allow investors to digest what was going on, understand what the probably true levels of tariffs would be that would be coming in, and how much negotiating power nations would have as they start to, I suppose, plan out how they deal with these tariffs that are going to get implemented. as you'd expect with volatility in risk markets or in equities and other riskier assets, the currency, and if we think of it from an Australian perspective, that's typically a risk-on currency. So when equities are performing well, the Aussie dollar gets a bit of support. When things are a bit more challenged and there's a bit more uncertainty, you see the Aussie dollar weaken. And if you see the chart of what that looks like, there's quite a substantial drop-off in the Aussie currency. Started the month at about 62 cents per US dollar, or the other way around, and then it dropped down to about 59. Where we are today, it's back into the sort of mid-60s. And I think generally the perception is, yes, there has been a bout of volatility, but the trend that's likely to come through from what these tariff and policy announcements are is that there's a desire for the US currency to be weaker, to make the onshoring and the competitiveness of the production of the US economy to be stronger. And to do that, one way they're thinking is to weaken the currency potentially. And so that should play out in stronger returns for hedged and I suppose better conditions for people who wish to travel and take advantage of a bit of a stronger currency than what we've seen over the last couple of years. And clearly we've seen the peak of interest rates, we think. Now tariffs may have a bit of an issue with that, where they may start to see increased inflation in the US, which is clearly something the policymakers over there are very cautious about, that they're not willing, even though they're getting pressure, to reduce rates, that they don't know what the implications of tariffs are, and they don't know how widespread that'll be in terms of general price rises in the economy there. So I think they're pausing for a period of time, although looking to the latter part of this year, US cash rates are expected to be lower. That's what the market's still expecting. Domestically, we've got, or the Fed meets later this week, I think it is, and then domestically we'll have a meeting later in the month. And I think the expectation is that there is room to move. Inflation's now at a point where it's seemingly under control, and many economists here are saying that there is room for the RBA to cut again.